Hello investors, I'm Stuart Cruz and welcome to Cruz Asset Management's Chart of the Day. And today we're going to be talking about growth versus value. Now, growth has been on fire for the last 3 or 4 years and has been really the only source of income or the only source of returns in 2020, as the top 5 stocks in the S&P 500 comprise almost 25% of the index. And without those names doing well, the rest of the 495 names are on average down. But what next? And what's the difference between growth and value? Well, a value stock is traditionally a stock that's making money now, and a growth stock is traditionally a stock or a company that's pouring their assets and their earnings back into the company and is dependent upon making money in the future. So what usually wins? Well, what usually wins is value. What's been winning lately has been growth. So am I saying that companies like Amazon and Apple and Microsoft and Google are no longer going to be the gargantuan companies that they once were? I'm not saying that at all. They make amazing products and they will obviously contribute to the economy and they will continue to do well, in my opinion. However, if you're buying or trying to buy a dollar of earnings 40 or 50 years from now versus buying a dollar of earnings right now, there are things that we need to consider. Some things are like interest rates. When interest rates are low, it gives you the ability to wait a longer period of time for that growth to catch up. When interest rates start moving up, well, people aren't quite as patient because a dollar in the future is worth less than a dollar now. So let's go to this long-term chart from long-term trends. And this is a growth versus value chart, a relative chart from the 80s to 2020. So it's 40 years of the difference between growth and value. And if we just eyeball this chart, we can kind of see that, on average, growth and value are around a ratio of 1 here. But you can see in the 2000s, during the dot-com craze, we hit a humongous peak growth value ratio of almost 1.7, according to this chart. 1.694. And then, what happened in those years after that? While the entire stock market was down, value was actually up in 2001, 2002, and 2003. So growth got crushed. Value actually did well in spite of most people's portfolio getting destroyed. If you stayed in growth during those times, you would have lost 80 or 90% of your portfolio, while value actually was positive. And now we've gone through a 15-year period where value was basically fighting back. And now you've seen this meteoric rise again in the growth and value ratio. Not quite up to the dot-com place that we were, but still way out of line with the long-term historic averages. So are we due for rotation? Perhaps. Now, I'm just suggesting that maybe you're going to have a continued run-up, but maybe if you are leaning a lot on growth, you want to start taking a little bit more off the table and going towards value, because the odds of the next 5, 10, 15 years are probably going to be in the value camp. So let's look at this a little bit more closely from our friends at White Charts. And I have up on this chart here Schwab's growth and Schwab's value ETF. And then down here, I'll have a ratio between the two. And you can see that that is also indicative of that more recent run-up. Now, I don't have years of 40 plus years of data because, frankly, Schwab's ETFs and no ETFs went back 40 years. So let's take a look at this particular run-up. And as we can see, the max over this last, let's say, 10 years, you see a real nice run-up off of this average, and it moves up quite a bit. Year to date, I want to focus in on a little bit more. You'll start to see, and let's do, I wonder if I can do, no, I can't do that. So let's see, we have a peak right around here. It looks like 2.279, and a sell-off. Now, I would call this a toppy chart. You hit a top, you hit a top, you hit a top. You did break through this top, so that tends to be a bullish sign. But it looks like this is kind of a ceiling right here. And if we see a turnaround or break through this floor, you could see a return back to value. And that would suggest to me that you're going to have and that I think the catalyst would be higher interest rates. So if I'm going to look at the 10-year treasury, which I'm going to put on this chart, and I'm going to go back, here's the original 10-year treasury. You see the 10-year treasury rate fell down to a bottom of 52 basis points, and this is a year-to-date chart. But if we go out 10 years for the 10-year treasury, again, you can see it looks like that average is around 2.4. Let's put up an average on the 10-year treasury. What did I say, 2.4? 2.2. Okay, off a little bit. So if we look at the average, it's around 2.2. The low is around 0.52. But what we've seen in the recent times is a nice little tick up over the last couple of weeks. You've seen not too long ago, we were at a low of 52 basis points. So that was back, what's the date? August 4th. And we flirted with that back here, back during the coronavirus lockdown. But now it looks like the economy is becoming a little bit more healthy. And it looks like, especially since we have the virus vaccination announced by Pfizer that its efficiency rate was 90%, we got to move up in the 10-year treasury to almost 1%. What that means is the interest rates are moving up, and that means that people are probably going to be less willing to wait for the earnings to come in. So if you have a company like Apple or Google, and I'm going to again do this on the fly, let's take a look at Apple's price and Apple's PE. I'm going to take off this, there we go. So we got Apple's price and Apple's PE up on the chart up here. Apple's PE hit a high of 40. It's down to 36, but its long-term average of Apple's PE, as I've been saying for a while, is probably in the 16 or 17 range. So 16.32, and it's more than two times that average rate. And it's really stuck close to this average PE ratio for quite some time and then zoomed up. You could say that's because of the low interest rates, but if interest rates are coming down, you could see Apple fall and get cut easily in half and still be more expensive than it has been in its average, just for its average PE ratio. I'm not saying that's going to happen. It could also just stagnate for a while, like is what happened to Microsoft. But what we're talking about is growth versus value. And you're looking at possibly a changing of the guards. So I might suggest if you are heavily invested in growth, that you start taking a look at some of these value names and how much is a dollar of earnings that you're paying for today worth versus what that dollar of earnings might be worth in 40 or 50 years from now. Because the long-term history shows that value has traditionally outperformed growth by about 2% a year over the last 100 years. So if I were a betting man, and that's what I have to do with people's money, is take educated, calculated bets with their money about where the odds are in your favor, I would bet that value is going to outperform over the next 5 or 10 years. This is Stuart Cruz reminding you to live your life with the odds in your favor.